When we think about the stock market, we think about money, the finance industry, businesses, and making money from investing in successful businesses. The belief is investing in successful businesses is what leads to investment profits. And there's a direct connection between the success of the underlying company and the profits investors experience. This is a reasonable idea, which is why it's in textbooks and recited by finance professionals who sell stocks and stock-related services. However, this is not how stocks actually work. Most finance professionals have no idea where profits from stocks come from. They just assume it gets magically generated from the complexities of the market. The myth is profits from stocks are generated from the earnings and growth of the underlying companies, and when a company makes money, they share the profits with their investors. But in practice, most public companies never pay dividends on their stocks, and when they make money, which can be millions or even billions, they keep everything. The reality is, profits from stocks come from other investors who are buying and selling stocks. When an investor buys a stock for $10 and sells it for $11, that $11 comes from another investor, someone who will then start hunting for yet another investor who will give him $12, and so on. This is technically a negative-sum scenario for investors because they are contributing all the money, and there are fees attached to every transaction. The company that issued the stock isn't involved in these transactions, so whether the business is making or losing money is irrelevant. This is why companies like Tesla Motors, who has lost billions since they became a public company, can still have stocks that appreciate in value. But in a situation where investors' profits are strictly dependent on money from other investors, investors can make or lose money regardless of whether the company they invested in is making or losing money. In reality, the stock market is a massive system that shuffles money between investors. It is a system where current investors' profits are directly dependent on the inflow of money from new investors, and such a system is also known as a Ponzi scheme. But what most people don't realize is that a Ponzi scheme can also produce a lot of winners. It's not a scam where everyone loses money, even with the presence of middlemen and fees. A lot of investors who are involved and unaware of the scam can make money too. The fraudulent aspect of a Ponzi scheme is not its inability to produce a few winners. The issue is in the mechanics and where that money comes from, and how investors who make money are taking it from other investors who also want to make money. But if the stock market is a giant Ponzi scheme, and it's as obvious as tracing the cash flow of a typical stock transaction, then why is it legal? If stocks are Ponzi assets, why are finance professionals allowed to sell them to investors? And why are there so many university classes and textbooks on stock analysis, but not one of them mentions the existence of this Ponzi factor? Finance professionals do not see the stock market as a Ponzi scheme because they believe in several fallacies. These are ideas that people assume are true because they heard it from someone else. But the credibility for these ideas come from repetition, tradition, and people who recite it, rather than proof, logic, or facts. The first fallacy and the most fundamental falsehood that leads to other false ideas is the notion that stocks are equity instruments that represent ownership in a company, and the value of the stock is connected to the value of a company. This idea is false because the values of stocks have no legitimacy. A real estate transaction has legitimacy because the value of the property is backed by the intrinsic physical value of the property itself. The value of a bond is also legitimate because there is a defined entity that is responsible for repaying the face value. But stocks have no legitimacy because no one has any obligations to repay the shareholders anything. A share of Google might trade for $900, but Google explicitly states in writing that the share has no voting rights. They don't share business profits with their investors, and Google is only obligated to pay the shareholder the par value of 0.001 cent for that $900 share. Finance professionals confuse stocks with ownership instruments because they ignore history. Before the 1900s, stocks paid dividends, so at one point, stocks were legitimate ownership instruments because there was a profit-sharing agreement between the shareholders and the companies they owned. That's how stocks used to work, and that is how stocks are supposed to work. But that is not how stocks work now. The second fallacy, which is a product of the first fallacy, is the idea that the asset value of a stock is the same thing as cash. When people see a share of Google that is trading at $900, they will just assume that is $900 in real money. But the value of a stock is just an idea. It is just a thought, something completely imaginary, which is why the price can rise and fall sharply at any given moment. On the other hand, money is an instrument for trade that is designed to serve as a medium of exchange for goods and services. It is in both physical and electronic form, and for the most part, it is finite and traceable. It is legal tender that is issued and backed by the government, and it is what investors ultimately care about. Investors do not buy stocks for the sake of having stocks. They buy stocks because they want more money. As of September 2017, the New York Stock Exchange and NASDAQ had a combined value of over $30 trillion. However, there is only $1.6 trillion of real money in circulation in the entire U.S. economy. The investors who are holding $30 trillion in stocks will never receive the $30 trillion in real money they feel entitled to because that amount of money simply does not exist. The third fallacy is the assumption that the stock market is positive sum for investors, and the system produces more wins than losses. This is why finance firms can label their products and services as investing rather than gambling, and why 18-year-old kids can open online trading accounts. However, the positive sum assumption has never been proven. To show if the stock market is positive sum, all we have to do is add up all the money investors have won and lost over the years and see if that adds up to something positive. The problem is, no one knows how much money people have lost. There is no database that tracks investor losses, and no one knows how much investors have been winning or losing over the years. The reason why people think the stock market is positive sum is that they believe in the second fallacy and think people must have made money because the stock market has grown to $30 trillion. But a real positive sum situation needs to consider the wins and losses of all the investors that are involved, which includes the last investors holding $30 trillion of imaginary money that doesn't exist. The idea that the stock market is a giant Ponzi scheme isn't new. As repulsive as this idea is to finance professionals, it's not an idea they can properly deny or refute. They cannot explain how investors can make money without taking it from other investors, or shed any light on how much money the investment finance industry has lost for investors over the years. The typical way finance professionals defend the Ponzi factor accusation is by bringing up hypothetical scenarios, such as what a company can or might do in the future. They'll say things like, Google can start paying dividends, or Tesla might start making money. Hypothetically speaking, anything can happen. The world of the hypothetical is only limited by our imagination. The problem is, those events are unforeseeable and don't happen in practice. But on the other hand, the Ponzi scenario where investors are feeding off each other while the companies they own hoard profits, this is not a hypothetical situation. It is what is happening in practice. This is a very real scenario, something we can observe every single day.
Ponzi factor explains why today's non-dividend stocks meet the definition of a Ponzi scheme. And Tan has undergraduate degrees in both economics, finance, and a master's degree in statistics. He's worked in finance industry for 10 years, and during that time, he's worked for 2 different hedge funds, had a career in managing distressed assets, and man, I'm so excited to talk to you. Tell me a little bit right now about how you actually got involved in the financial space.
Thanks for having me, Blake. Initially, I got involved in finance for the same reasons a lot of young men try to get in finance. It sounds exciting. It sounds like there's a lot of money in it. And it is exciting. Why? Because it's gambling. Okay, it's gambling. And the thing is, you think that there's a way to game the system. So like most people, I got into finance for those reasons.
Very interesting. And I mean, have you always been skeptical of the market?
No, initially I loved, in fact, I was very passionate about what the stock market was in my 20s. And when I first started working for my first hedge fund out of college. And I, like many people right now, think that money grows on trees. So you think that you could just create these things called stocks, shuffle it with real money, and somehow create more money for everyone to play with. Except for that idea itself from the very beginning, even in school, was a little bit shady for me. As in, even though I wanted to believe in the system, the stock market, Wall Street, part of it just never really clicked on why that makes any sense. And personally, I just thought at the moment, that time, well, this is just how things work. And I'll have these questions answered later because I'm such a novice. Except for the issue is, as I continued to work in finance, I realized those questions were never answered. In fact, they were just completely avoided by people in the industry. And they just assume that you can indeed create things called stocks, print as many as you want as a company, and shuffle it with real money with investors, and somehow give people more money than they contribute, which makes no logical sense. So initially, one of the biggest surprises, I guess, biggest surprise when I first started working for a hedge fund is I realized that you try to game this system, but it's all gambling, in the sense that there is no way to really game the system. There is no way to actually get a real definitive advantage. And basically there was no way to really promise our clients something positive in return when we couldn't promise. But that's what we were selling, though, because there was no way for us to guarantee a really positive return, or any positive return for that matter.
Okay, so let me hold on for a second. So this is while you're at the hedge funds, right?
In the very beginning of my career, yes.
Okay, got it. And so in this time period, you're like going out. You want to give this world-class customer service.
Mm-hmm.
You want to provide them the returns and then you're seeing behind the curtain.
Yeah, exactly. Yeah, you want to sell, returns, and basically what I really, really understood from that first experience, really my first year in finance, was working for that hedge fund was analysis, and all that stuff was secondary, if not third. The number one goal, the number one objective every single day from the fund manager was how to get more people to invest in the fund, how to get more clients in the fund, how to sell your services to more people so they give you money, not analysis, not anything. But the number one objective was to get money into the fund, not the research aspect of it.
Yeah, that's so interesting, because on the front side of it, if on the front of a business, traffic looks good. Traffic means it's successful traffic. And so what I hear you saying is without that traffic coming in, then what?
Well, perhaps the most ideal situation for any hedge fund, right, is you get some people to invest, and then you actually show the returns. And the thing is, most hedge funds, first of all, 90% of them, from what I understand, are actually under 10 million or under 100 million, and they basically go out of business within very, very, very quickly. But majority of those hedge funds, what they're doing is, yeah, everyone's always trying to get something positive for their clients. That's, without a doubt. The question is, are they actually in control? The answer is no. And what usually happens is, oh yeah, of course we're trying to get something positive, but the number one goal is to keep getting the traffic in, as you say, keep getting more investors to invest. Because why? Because chances are you're not going to be positive, you're going to be negative, and basically the way you offset that is by getting more people in. And I will say one thing: there is one definitive advantage in finance, and that is if you have more money. Okay, you can stand more losses and stuff, and you can do more things to hedge or whatever it is, right? So capital is indeed one advantage, but it is it's the truth for all kinds of investing, not just stocks, right? You have more money, you just have more advantage. So yeah, initially they're always about traffic, always about sales. And what I realized in that first year was, you don't have to have a degree in finance. Okay, you can just be a salesperson and sell. In fact, from what I read an article a while back, yeah, those are the people at Goldman Sachs that make the most money. They're not people who research; they're people who sell. And that's what I realized in that first year of finance is that it's all gambling, and really the day-to-day activity is not about research and analysis, but about selling and getting more people into the fund. And that was quite a disappointment to me.
Yeah, I appreciate you sharing that. And so, just to kind of bring it home, okay, so my name is Bob now, and I want to kind of process this with you. I'm hearing you. I've got about $1 million, with a hedge fund, and I hear you saying this, but I'm not. I look at my statement, and my statement still says I have $1 million, and it's making something. And so, help me understand how that applies to me as my statement.
Well, if you have stocks, first of all, your statement is probably in terms of asset value, not cash. There's a part of the statement that's cash, hopefully, but chances are what you're seeing is value. And the reality is, if you see $40,000 of value, stock value, that equals $0 in real money. Value is something that comes from the exchange of money. It is an abstract number. That's why it literally can just jump up and down any given day, depending on whatever the market conditions or whatever the market does. On the other hand, money, real cash, is something that is real and possessible, as in you can possess it. The value comes from the exchange of money. It is fundamentally different from the money that is actually being exchanged. So when people see these statements, as you say, with like $1 million of value, that's not money, dude. When you own stock, the first thing you do is you get rid of the money that you have, and you don't have any more money. And then you hope to get it back later on from somebody else. And the valuation formula, I want to add sorry to throw in a silly math example, but the valuation formula itself is also very flawed. Okay. I'm going to give you a quick example real quick. For example, Google, I believe, has about 800 million shares outstanding. Let's say 400 million shares for the C class shares. 400 million shares. All right. If it's trading at, let's say, $1,000, right? Now, if I buy just one share for $1 more, so $1,001, okay? That $1 additional I contributed to the price of Google will be multiplied 400 million times. Okay, so what I'm saying is, if you do the math, the actual market cap formula, the valuation formula, is last price times the number of shares in your portfolio or for the whole market. If somebody just buys, because the shares are never 100% traded, usually liquidity is less than 1%. So that one price for really less than 1% of shares is automatically distributed to the entire shares, all the shares that are outstanding, which is fundamentally flawed, because if I buy just one share of Google for $1,001, for $1 more than the last price, that $1 will be multiplied by 400 million shares, and all of Google investors as a whole will see an increase in their net worth to the tune of $400 million, even though I just contributed $1. That shows the flaw.
So, okay, very interesting. So to break that down, what I hear you saying is, is not only is there a flaw in their system, but one thing that you say in the Ponzi's factor is that now there's a large percentage of stock businesses that the stock on the business, the dividend isn't even tied. So if Bob buys into Google,
Right.
not even getting a dividend, right?
Right.
Tell me
So,
more about that.
okay, sure. So let's actually get to the heart of the book, because that's what the heart of the book is about, which is there's two ways you make money from stocks. One is dividends, which is the money you actually receive from the company, from the business itself. And another is capital gains, which is this whole buy low, sell high thing. You buy Google for 1,000, you sell it for 1,100, cool, right? Except for one thing, the capital gains aspect most people don't quite understand is that when you buy for 1,000 and you sell it for 1,100, that 1,100 does not come from Google. It comes from another investor. That person will then have to sell it for more than 1,100 to get his or her money back. So basically, it's a system that shuffles money between investors with fees in between every single transaction. So it's by nature negative sum. And the most important aspect of what that implies is Google never pays the shareholders. That's the ultimate problem with the scenario, is that when there are no dividends, investors receive nothing from the companies they own.
It's so fascinating. So, and back when the stock market started, when it actually was formed, the business was actually tied to the stock. So if me, Bob, now obviously my name is Blake, but if me, Bob, the investor, goes and buys $1 million worth of, let's just call it Google for this matter, back in the world when the stocks began, I would actually truly own a portion of the company, right?
Correct.
What's changed?
Hmm?
What's changed?
What's changed? So stocks initially started around the 1600s, and basically up until the 1900s, they all pay dividends because that's just how you're supposed to make money. You're supposed to buy a piece of a company, and when they make money, you get a piece of profits. Real simple, end of story. Sometime around the mid 1900s, and this is not very clearly documented at all, because finance people don't actually care about this type of information. Dividends completely disappeared, or not completely, but a lot of non-dividend stocks started appearing, and now obviously it seems like normal. Oh yeah, they don't have to pay dividends. What the hell are you talking about, dude? What do you mean the company doesn't have to pay the shareholder? Now it's just normal, right? But the thing is, around the 1960s or 50s, non-dividend stocks started popping up, and these Ponzi assets, as I call them, now pretty much dominate the market, and people are justifying their existence when in reality the truth is supposed to be very simple. You buy a piece of a company, they make money, you make money. Not you buy a piece of paper, they make money, you get nothing, and maybe you could sell that paper to some other douchebag. Okay, so which is exactly how it works now. And the finance junkies I debate with basically defend this bigger fool's idea. Oh, the company doesn't have to pay you; you just get your money from someone else. It's like, are you guys how far deep are you in the Kool-Aid? Okay, very very deep. But yeah, that's the reality we live in. And I also want to address one thing about buybacks, because this comes up a lot. Stock buybacks are seen, or actually portrayed often, as returns to investors as an alternative dividend, meaning the company buys back their shares. That is not a return to investors, because these companies who buy back stocks have the option, and often do just print more stocks after the buyback without announcing anything. So if you hear CNBC talk about buybacks returning $1 trillion to investors, they do not mention dilution, which is all the shares they issued without telling anybody, without announcing anything.
Okay, so let's break that down. So, I've got $1 million in the market, and where the stock that I have, it looks like they're buying tons of my stock back. And so, on paper, big picture, I'm not taking any money out, but it looks like on paper, I'm going to make a lot of money. But what you're telling me is they also then add a zero, dilute the stock, print electric numbers, and
Hmm.
then it's basically a way of manipulation. I don't really get anything back for it. They just actually cooked the books and made their numbers look really good.
Yeah, basically they say, "Oh yeah, we're buying back stocks. We're buying back stocks." Except for, why aren't you telling people, or more importantly, why isn't the media reporting it when you're diluting? Every time a company issues stock options to employees, as in paying employees with stocks, that's total BS. There's no such thing as paying your employees with stocks, because your employees don't want stocks. Okay, they want money. They're going to take those stocks and get it from another and sell to another investor to get their money back. So there is no real thing as stock compensation. It's all just printing stocks to employees, which adds to the dilution. So a real simple, obvious example is Morgan Stanley, AT&T. These are dinosaurs that have been around for almost a century. If their buybacks were legitimate, they shouldn't have any more stocks by now. They should have bought them out, but they should bought them all back by now. A lot of these, so obviously stocks, there's something very wrong with the whole idea of stock buybacks returning to money to investors, is because they just simply print more. So I've been talking about dividends, I've been talking about capital gains, but I do need to address that because that does come up and it is often falsely portrayed as a return to investor. And I will also mention that what I just described about buybacks is not like my own so-called theory. It is a known fact for anyone who's done equity risk premium research, which is actually research in a niche topic about the historic returns from stocks. So anyone who does any real deep research like that, which I've done, by the way, we understand and we do treat buybacks with dilution. We don't ignore the dilution aspect of it.
It's very interesting. And so what you're saying is the truth is Bob could actually make money in the market. He could lose money in the market, but whether he's making money or losing money, it has nothing to do with the company who he thinks he's actually involved with. It's
Mm-hmm.
actually just other people on the merry-go-round,
Yeah.
and they're actually just getting excited or deciding to move out or getting excited. And so they're buying at a higher price or a lower price. And the money managers are making a fee every single time something happens. The
Right.
stock market's making a fee. The stock's making a fee every time something happens. And then if I'm selling and I'm making money, or whatever
Mm-hmm.
I'm in, if I'm making
Mm-hmm.
money, it's tied to the merry-go-round, not
Yeah.
the actual companies in the market.
No, very true, very true. That's exactly it. Because what I want to point out is there a connection between the stock price and the underlying company? Yeah, it's called a speculative connection. It is not a legal one. It is not a logical one. It is not a monetary one, because you get no money from the company. Now, there is a speculative connection, though. But then again, everything in the world under the sun has speculative connections. Okay, and I will say there are some stocks that move more speculatively in line with the fundamentals versus other Ponzi assets that are completely out of whack, like for Tesla Motors, for example. The company's lost $6 billion in the past 10 years, and the stock has went from $20 to $800 while they lost $10 billion. And who knows, maybe we're going to lose another 10 billion 20 years from now, next 10 years, and the stock's going to go to 2,000. Okay. But it basically, that defies logic. And of course, the finance junkies are going to say, well, it's about future value. It's about, future expectations. No, but the point is, if the stock is actually monetarily connected with the cash flows in the company, that cannot logically happen ever. Okay.
Right.
And it's not just Tesla. There's Shopify. There's Wait. List goes on and on. I have a whole list of them. But also the reverse is also true. You also have these situations with stocks staying relatively flat, and investors ultimately make nothing over a period of time when the company makes billions and billions of dollars. Google, for example, is a great example of that. 2007, 2011, stock remained, I think, around 700 or something. It's an example in my book. And the company made $28 billion during that period of time. So as a shareholder, you would have got nothing for holding that thing for 4 years, but the company received $28 billion. And same with Berkshire and a whole bunch of other companies, same thing. Yeah.
And so all you have is what you're saying. All you got is a speculative price change,
Mm-hmm.
and whatever the price went up to during that, from 2007 to 2011, the speculation of that number
Yeah.
is all the statement's going to show of your value. but it's
Hmm.
just thin air because it's not backed by collateral.
No, you get nothing from the company. And
Oh,
some people say, "Oh, yeah, you're just cherry picking dates." No, dude, if I want to cherry pick dates, I could tell you periods of time when investors would have lost money with Google while they made $28 billion. Why they would have lost money. All right,
isn't
so I'm
that
actually
crazy?
very neutral, saying, "Hey, they made no money." But if I
Yeah.
want to cherry pick, I could cherry pick, and I ain't even cherry pick
Right. So fascinating. Okay. So, our listeners are those who are in they own businesses, they're an executive, they could just be the hard worker um, in the 40, they're just throwing money in a 401, an IRA. And now they're kind of waking up because now they're like, I'm actually to a point where I need to start paying attention. I need to know what I'm going to have in the future. I need to know retirement wise, can I retire? Should I continue to work? Like I just don't even know. And so
there.
this is great education. This is tangible stuff that they can actually start processing of, you know, I want to have something that I can count on. I want to have something backed by something. So tell me
Hmm.
more about so the bold statement of Ponzi factor is bold, and you just kind of broken down, sliced through of why that's this Ponzi asset is actually what it is.
Hmm.
Um, but just for a little bit more clarity, define why would you call it a Ponzi asset, the stock market?
Why do I call it a Ponzi asset? You mean non-dividends?
Right.
Stocks. Well, because stocks are seen as an asset, okay, as a thing, and an asset is technically something you buy and you're supposed to sell for more money, right? Which real estate, yeah, that's an asset, but the thing is, it's real. Okay, you don't just print a house, okay. Whereas Google prints millions and billions of shares, and freaking Tesla, their
Right.
shares outstanding have doubled since 2010 when they went public. They printed like 100 million shares over the past 10 years. So Ponzi asset meaning it's literally imaginary. It takes no effort to produce, and you think it's an asset, but really it's not a real asset. It's something that you can only get from selling it to a bigger fool, just like you, in a system that shuffles money between investors. And there is no intrinsic value in it, whether you want to believe that there is or not.